How's it going, everyone? Welcome to the very first episode of the Investment Hound podcast. On this podcast series, we'll be discussing how to be a successful investor and how you, a beginner investor, can achieve realistic investment goals in stock markets around the world. My name is Adam Buggy, the novice investor, the student, the host, and also the grandson. And in this podcast series, I'm going to be joined by a veteran investor, someone with vast experience in economics, finance, and investing, a former director of corporate banking for Bank of Ireland, who also happens to be my granddad, Mr. Paddy Strong. On this episode, Grandad and I discuss why you should invest in the stock market, when you should invest, and also dividends. Now, if you want to go at your own pace, or you're not a podcast listener, or even if you're looking for a good, useful present for a loved one, be sure to go and grab yourself a copy of Grandad's new book, Successful Investing: How to Make Money in the Stock Market from Real Life Experience. In his book, Grandad discusses his journey through the stock market, giving you an in-depth understanding of his strategies throughout the years, really simplifying it down so that it's easy to consume and understand for a beginner investor. Don't get me wrong, the stock market can be a very intimidating place. I know exactly how you feel. Tons of new numbers, graphs, terminology, and so on. But in his book, Grandad really simplifies it down so that it's easy to consume and understand. So make sure you go and grab yourself a copy of his new book, that's Successful Investing: How to Make Money in the Stock Market from Real Life Experience, by Mr. Paddy Strong. Last thing, if investing is something that you're interested in and you do like the podcast, be sure to go and follow us on all social medias at The Investment Hound. Now, if you want to ask Grandad any investing related questions, either comment down below on the video, depending on where you're listening to this, or send us an email at paddy@theinvestmenthound.com. That's Paddy, Paddy, at theinvestmenthound.com. Now, enough of me rambling on. Let's get to the podcast. All right, let's get started. So, Grandad, the burning question that we all have, all of us beginner investors, people who are interested in investing in the stock market, why should we invest in the stock market?
Well, it's, in my view, a very simple answer to that question. All the long-term evidence shows that the stock market is one of the safest and most lucrative places to invest your money. It's not unusual, obviously, for stocks to drop by significantly, and the main thing you have to do there is you have to hold your nerve. If all the shares in the market fall, then the market falls. The market will correct, and the reason it will correct is because, first of all, the central banks will be worried about the slowdown in economic activity and the falling prices that all that entails. So what they'll do is, they'll actually drop interest rates, and that will give people more money to spend. Businesses won't have to pay so much in interest, and mortgage holders won't have to pay so much in interest. So that's the first thing that the central bank does. Then the government will discover that they can raise money more cheaply. So they'll borrow more and pump the economy, pouring money into the economy. And then businesses, because they'll have more money, will actually invest more. And as a result of all of that, human nature or human ingenuity will cause a turnaround in the situation, and the economy will start to grow again. And then your shares will bounce back. And that's what all the research shows. So the trick is, in fact, to buy when the markets are down, because that's when the really good shares are cheap.
Very good. And why should a young lad like me trust your judgment, Grandad?
Well, let me try and think. I mean, what I would say to you is this, right? I mean, I remember you when you were a little fella and you were learning to walk. You kept falling and rising back up, falling and rising back up, falling and rising back up until you figured out how to keep your balance. And then you were able to walk. When I started building my investment portfolio, I was a little fella in investing terms. I made mistakes. And I made more mistakes and more mistakes, but I like to think that I learned from my mistakes. And so therefore, I think I can provide you with my experience. You don't have to go through the same mistakes making that I went through, because I can tell you what those mistakes, how they happen, and how to avoid them.
I think so just for the listeners at home, obviously this is our first podcast, Grandad. And from my investing experience, I have very little investing experience for everyone listening at home. All I invest in is the S&P 500, which we'll discuss later. However, when COVID came, when everything crashed, I did, and the government started to issue everyone COVID payments for people that were unable to work because they closed down businesses. So I worked as a waiter. They started issuing COVID payments. And of course, I had extra money now and I couldn't go out and spend it. So I started to dabble in the stock market. And the one I always tell you about, Grandad, that we just talk about off camera, is the biggest investing mistake I made was Hertz. So when I had bought Hertz, when they had dropped dramatically in price, except I had bought them and they kept going down. And then when they went down, I got scared and I sold them, even though it was not even worth selling them. It was only 20 cents was the value of the portfolio. But that's that's just to give people kind of context of where my investing experience is. Obviously, you've great investing experience. Do you agree?
I do, yeah. I've always say to people, any fool can buy a share. The real trick is to know when to sell it, And sometimes you're going to get that wrong. And sometimes you're going to get it right. And I do give you rules later on around when you should sell a share. But you learned a lesson there. And that's what I mean by falling and then getting up and trying to walk, and falling and then getting up and trying to walk. You learn those experiences. And that's why experienced fellas over time have a lot of tricks that they don't even realize they have when they actually do things, right? So I began to invest in a stock folio just as the disastrous consequences of the subprime crisis happened. All the shares were on the ground. And that's when I invested.
Okay. So just as you said at the beginning there, people should invest in the stock market because over time they bounce back. So you invested in 2007, 2008 after the big mortgage crisis because shares were cheap.
Yeah. I mean, let me ask you a question. Coca-Cola, which is the one example I used to give my students in the past, right? When was Coca-Cola founded?
1905, maybe.
Oh, you go back into the 1800s, okay?
Oh wow!
Now into the late 1800s, admittedly, okay. But the point is this: if people were drinking Coca-Cola in the late 1800s, and people were drinking Coca-Cola in the late 1900s, and people were drinking Coca-Cola in 2020, what makes you believe that you should go wallop? I mean, that would seem to me to suggest that if they have anything at all, they got longevity. They're a share that are going to last. And then if you look at a share like that, when the markets are down, not when that share is down, but when all shares are down, when the markets are down, and you see that it's trading very lowly, is that not a bargain share, Adam? I think it is.
Yeah, it would be. Yeah.
But to do it is a very dangerous thing to convince yourself. Oh my God, what I'm doing, everybody else is running away and I'm running in. It's a hard thing to do, but it's the sensible thing to do.
So how did you feel then during the 2007, 2008 mortgage crisis? How did you feel when you began investing?
Well, I had that kind of view, but I hadn't that experience because I was only a sort of an infrequent investor. I had done a bit of investing in 1999, and then I started doing a little bit of investing, coming up to the crisis, 2008, 2009, 2010. You see, the interesting thing about saving is people don't always have money to put aside. Sometimes times are tight. So, for example, if you've got 4 children, a big mortgage you've just changed your car, okay, things might be tight. You might say to yourself, well, I won't be saving this month or next month or the following month. And then at other times, you might get, say, a legacy. An uncle might die, and you might get a legacy. Or you might win a lottery ticket, or you might have got a big bonus in work or something like that. And in those circumstances, you have spare cash. So at the time that I started going in was shortly after I had retired. Because when you retire in Ireland, you take a lump sum out of your pension, tax-free. So I now had cash and I had to deploy that cash. So I was slowly learning the game. And I started around 2007, 2008. I started looking at the markets and then gradually dipping a toe in here and dipping a toe in there and learning the game. So it coincided with me having money, and I don't have much money today now, but I had money then.
So it was good timing.
I was lucky. I was lucky that I retired in the end of 2004. So I should have started in 2005 and 2006 and 2007. But I was busy studying, trying to figure out what I should do and how to go about it and all that kind of stuff. So anything I put in prior to 2008 isn't worth talking about, right? But by the time 2008 came, my wings were now fully outstretched and I had taken off and I had started to invest and save seriously in the stock market. When I say seriously, not modestly, but gradually building up over time. That's the way I did it.
You actually started studying the stock market from 2004 when you retired, but you didn't actually invest seriously until 2008.
I was trying to learn, for example, it's very difficult to know as an amateur, is a share cheap or is a share dear? You can obviously look at a share and you can see that, for example, it's rising all the time. And you might say, oh, well, that's a dear share. But yet, a lot of people buy those kind of shares. They call them growth shares. Or you could see a share falling all the time. And you might say, oh, that's dangerous. I won't go near that share. It could be going to go like Hertz down to zero. So I won't invest in it. But there does come a point where, it makes sense to take a view, well, is it down as far as it's going to go? Is now the time I should be piling in? You were selling at the bottom. The trick is to sell at the top and to buy at the bottom. I mean, you think about it, if you're going to buy a car, you're not going to buy a car at the top so that, you're buying it when it's overpriced. You're going to buy the car when it's trading, you think, cheaply. So you have to find a way to understand when shares are trading cheaply and when shares are trading dear. And we know that shares are a function of the health of the companies that they represent. So if we'll say Coca-Cola has a very bad year, well then, the share price will be down. But if the whole market is down and Coca-Cola's down along with all the market, that's not a problem specific to Coca-Cola. That's a problem specific to the market and the politicians and the businesses and the consumers and the central banks will all work together to move the markets back up again. They won't be moving the markets back up. They'll be moving the economy back up. But because they're moving the economy back up, that means businesses will become more prosperous. And if businesses become more prosperous because economic activity is expanding, then in fact people, of course, will then see the share prices start to move up. So the share prices are the result of the efforts of others.
Okay. So they're interlinked between the health of the economy and the health of the company.
Yeah, because it's a bit like, let's say that you have an apartment and you're getting, we'll say, €1,000 a month in rent. And I have an apartment and I'm getting €2,000 a month in rent. Which apartment will sell for the most money?
I would expect the one that's 2,000.
Yeah, absolutely correct. So therefore, if a company's earnings are rising, its share price, all things being equal, will tend to rise. And essentially, if an economy is to grow, it has got to get a lot of its businesses in the economy to actually grow. And if the businesses in the economy are growing, then the earnings of the companies will be growing, and therefore the share prices of the companies will start to grow. So that's the argument for buying when economic activity is, if you like, in at a low ebb, and sell, if you wish, when the economies are booming.
Okay. And you typically tend to look out for companies that have been around for a long time.
Yeah, one of the things you're looking at for is pedigree. You know, if for example, you get a doctorate in Harvard, and I get a doctorate in a small little university in a small city in Ireland, okay? Which has the better opportunity? Which graduate has the better opportunity? The Harvard graduate or the graduate from the small university in Ireland?
The Harvard graduate.
The Harvard graduate. So you know that based on what's happened here, you know that this guy's pedigree is stronger than the other guy's pedigree. Correct?
Yeah.
So, you know that if you were investing in, we'll say, Coca-Cola, right? It's got a lot better pedigree than if you're investing in a new Irish whiskey that came out 2 years ago, which hasn't yet proven itself. So the length of time and the ability of businesses to weather all the storms over many, many decades is a comfort factor when you're trying to choose a share. Not the only comfort factor, but it is a comfort factor.
Okay. And what are some other comfort factors?
Well, essentially what you're doing is you're looking at longevity. But then you need to look at the strategy of the company. For example, Coca-Cola, immediately what comes to mind in your mind is, a bottle with brownie stuff in it, right? And a red kind of covering, okay?
Mm.
That's immediately what comes to mind. But what you don't know is that about 4 years ago, Coca-Cola bought one of the biggest cafe outlets in the UK and Ireland. Okay? So they diversified out of Coca-Cola into coffee and scones and, Danish and things like that. Okay? So they're broadening their offerings the whole time. And the bigger the company, the broader the offerings they have. So that if Coca-Cola itself becomes unpopular, well, you have the coffee to fall back in. Or if the coffee becomes unpopular, you have Coca-Cola to fall back on. So the bigger the company and the longer it's going, the more strings it has to its bow and the more likely it will survive and continue to deliver.
Okay, very good. So you tend to look out for these long, established, diversified companies. So as in diversified.
Well, big companies tend to be diversified. It's very, very few big companies have only one thing. Like Facebook is rapidly trying to diversify out of its platform. You know, but most businesses of large size have lots of different arms to them. And that's in itself, and they operate in different geographies, So, for example, Coca-Cola, you think of as an American company, but they bought a UK, Irish-based coffee business, right? So, in fact, they're not only operating primarily in the US, but now in that particular arm, they're operating primarily in Europe.
So, you would tend to look out for these companies then, especially when there's economic crises, such as the 2008 financial crisis, COVID.
Look at what happened to Hertz.
Other crisis, Grandad?
Look what happened to Hertz, Adam. Hertz was a do you want to hire a car business, okay?
Mm.
And then when COVID came, nobody wanted to hire a car, so Hertz was in deep trouble. But if Hertz was also in the ambulance business, say, hiring out ambulances, then they would have had a second trick up their sleeve, if you like, when COVID came, and they would have made money out of COVID much more so than under normal circumstances. So businesses have to find different things that give them comfort when something doesn't work. There's something else there that will work. You know, that kind of a way. And the bigger the business, the easier it is to do that.
Okay.
And that's why I'm saying to you that you have to be very, when you're beginning in the stock market, pick the big, long, established, large companies that are well known in their markets, and have a look at their strategy and say, are they trying to make things better? And if you feel they are, well, give them the benefit of the doubt and stick a few bob into them or a few grand into them or whatever.
So what did Granny think of all of this investing during a financial crisis, Grandad?
Well, now, Adam, you're not going to tell me that I sat down and told Granny that I was going to invest money when markets were at a dangerous low ebb. But you see, the way I look at it is, if you take housing, like Granny would understand houses, okay? And she would know that if house prices collapsed, they would keep falling and falling and falling. And eventually people would be saying, do you know what? That house is well worth that price. I mean, last year it was costing, say, $300,000. And this year it's only costing $170,000. I think it's well worth it at $170,000. You couldn't build a house today for $170,000. I'll buy a house. So what happens is when house prices fall, they eventually fall down so far that people get tempted to buy back into them. Now, the same thing happens with anything that people are selling. If their prices are falling, eventually, provided they're not, you're not selling ice cubes, in at the North Pole, right? In other words, provided they have some sense that some people want whatever you're selling, okay?
Yeah.
If the prices fall, eventually people will see them as bargains and they'll buy them. And once they start to buy them back again, right, then the prices start to go back up again. So it's unreasonable to assume that if prices of all shares are down in the market, that they won't come back. Now, you never, ever buy a share that's down when all the other shares are up, because it's actually an outlier. It's doing something that nobody else is doing. But if all the shares are down by 10 or 20%, then, and you can buy really good companies in that time frame that are down 10 or 20%, they have to be seen as cheap, haven't they?
Yeah.
Now, don't rely on me. There was a guy called Baron Rothschild. The Rothschilds are a very famous banking family that had been around for 300 years or so and know their way around investing very well. And what he said was, buy when there's blood on the streets. And in fact, the real quote was, buy when there's blood in the streets, particularly if it's your own. So in 2008, I had Bank of Ireland shares, which I had bought while I was working in the bank, supporting my own bank, if you like. And all those shares, they peaked in 2008-9 at €18.75. And by 2010, what were they worth? Do you know?
No.
7 cents.
Oh my God.
Okay.
Yeah.
So I was stupid enough to hold on to shares, which just went down and down and down out of sight in exactly the way that you did the same thing with Hertz, except I'd rather more money in my own bank shares than you had in
Yeah.
Hertz. Okay.
Yeah.
So that's why Rothschild said, buy when there's blood in the streets, even if it's your own blood. And in many, many cases, it is your own blood. That's the time to buy.
So did you buy more Bank of Ireland shares?
I didn't because I had held on to them. And so I already had a holding in them, even though they weren't worth very much. But they did bounce back somewhat. Not a huge amount now, because there was a terrible crash, a banking crash. It was a once in an 80. They reckon it's an 80-year event when the stock market crashes like it did in 1929 and it did in 2009. They reckon that's an 80-year event. But normally speaking, outside of that once in an 80-year event, the stock market is perfectly safe. The other thing was it was mainly the bank shares that crashed, whereas they were an outlier, if you like, to the market as a whole. The market as a whole did crash, but nothing like what happened to the banks. So effectively, I did buy AIB shares. In fact, I started by buying American bank shares because the American banks didn't suffer the same losses as the European banks, because the American banks sold all their bad loans to the Europeans, right? And so only about 10% of the losses that the banks ultimately paid for in America was only about 10% of the problem. 90% was exported overseas. So I said to myself, I'll get into America now because those banks are going to bounce back sooner. And I started out with Wells Fargo, for example, and I went into JP Morgan. And then I rested easy to see. And then I watched the shares going up. And then I sold them and made a bit of money.
Happy days.
So that's the thing to do. It's to actually buy when good companies are on the floor, and then to actually sell and make some money out of them. The other thing that actually retail investors or infrequent investors do is they meet a guy and the guy says, I bought this particular share and it's gone up by 25%. You should buy it. And they go on to buy the share after the price has risen. That's ridiculous. You don't buy the share after the price has risen. You should be buying the share before the price has risen. And then what happens is they buy at the top of the share, and then the share wobbles back down, and they panic, and they sell when the share bottoms out. So they buy high and they sell low. And that's a huge mistake to make.
Yeah.
So, and that's what we all did. We all met fellows who told us to do this, that, and the other. You really have to, put your own thinking cap on and think just using your common sense.
Yeah. So you buy when there's opportunity in the market, and opportunity presents itself when shares are priced cheaply, and cheaply being like during market crashes and stuff like that, isn't it?
Well, yeah, if they do say that shares often, the markets often decline by 10%. And they call that a correction. In other words, what they're saying is the lads have lost the run of themselves. We'll have to correct the market back down to where it should be. And they'll drop the market back down by 10%. Okay? They'll rise by 10% and fall by 10%. They also have a situation where the market rises by 20% or falls by 20%. They call a market that rises by 20% a bull market. In other words, the bulls have rushed into the market. Remember, when bulls tackle a matador in Spain, one of these sword fighters, whatever you call these guys, bullfighters, they rush at them, right? And so a bull market is where you rush in. So when the market's rising up towards 20%, loads of people rush in, okay? But the chances are that people say, oh, it's gone too hot. We better move it back down a bit, Okay, so it's quite often you see markets going up and down by 20%. When they go up by 20%, they're called bull markets. When they come down by 20%, that's the bears. I don't know whether did you see that movie Jungle Book?
Yeah.
Do you remember
When I
the
was a kid,
bear in
yeah.
the balloon? And when he
Yeah.
was fighting, he was fighting walking backwards and jabbing and walking backwards and jabbing and walking back. And so bears fight by going backwards. Bulls fight by going forwards. So a bear market is when people are running out of the market. A bull market is when people are running into the markets. And they reckon a 20% plus or minus is fairly common. Okay, so what you do is you don't buy when the market's up by 20%. You wait till the market comes down and then you buy. Or you don't sell when the market is down by 20%. You wait until the market goes back up a bit and then sell it. So that's the bull and the bear markets. And
Grandad, do you see when you say the market goes up by 20% or down by 20%?
Yes.
I just want to clarify with you, okay? I think a lot of people at home, beginners might think that can happen within a day, but that tends to happen over the space of months, if not years, doesn't it?
Well,
like it's very rare I turn on Bloomberg in the morning and see that the S&P is up 10% or down 10%.
that's correct. That's correct. But all you have to do is to go into Google and ask Google to give you the chart or the graph of the S&P, say 500, for the last, say, 3 years. And you'll very quickly see whether the market is trading at a high or it's neutral or it's trading at a low.
Yeah.
It's very easy to do that, or go into the FTSE chart, or go into the DAX German chart, or go into the Nikkei, the Japanese one. It's very easy to go in and see whether the market's trading high or neutrally or low. And time your purchases when the markets are at a low. And go for the big, long standing companies that pay good dividends. That's what I do. Well, a dividend is a share of the profits you get. If let's say a company makes, we'll just say in simple language, the company makes 100,000 of profit, and it decides to distribute, let's say, 50,000 of that, and I own 10% of the shares. I get 10% of 50,000. Which is 5,000. So that's paid into my bank account by way of a dividend. If I owned 40% of it, I'd get 20,000. 40% of 50% of 50,000 is 40,000. Is that right? No.
20,000.
40% is 20,000. Sorry, I beg your pardon.
Yeah.
20,000. I'd get 20,000 of it, right? So effectively, the companies declare a dividend every year, and you should be looking for a dividend of 5% plus. Now, you don't want a dividend that's too high, because if it's too high, there's something wrong with the company, and they're trying to encourage you to buy shares by paying you a high dividend. But 5 or 6% of a dividend is, even 4, 5 or 6% of a dividend is an acceptable dividend rate. And the interesting thing about that is, that's a very good return on your money.
4 or 5%. So, what you look for companies then that pay dividends of 4 or 5%?
Well, I'm tending now to. I started out and I thought maybe 3.5% would be normal, right? But the companies are now paying much higher dividends than they did in the past. So I'm now kind of thinking 5% would be the very minimum that I'd be attracted to buy a share. And my overall portfolio is earning over 6% as we speak. That's a very good return on your money.
Yeah.
And effectively, you would expect also the shares to go up over time, because you'd expect the companies to be trying to grow all the time. And, to the extent that they grow, the shares will grow. Share prices will grow. So you'd expect a gentle uplift in the share price as well. An awful lot of novice investors are trying to make a killing on a share in a very short period of time. I'm happy if I can get my 5% every year on the dividend, and then I can maybe get 2% on the price every year. That's a 7% return on my money. What's wrong with that? Keep that. I'll be able to save plenty with 7%. I'll be able to go away on plenty of holidays. I can tell you, with my spare cash, if I'm earning 7% on my money.
I think that's a common trait among people my age, Grandad, is that they expect to invest in the stock market and become a millionaire.
Yeah.
Overnight.
Yeah. It's a bit like if you
which is
go
not
to
the
a
case.
horse race. You can, if you don't know an awful lot about horses, you can bet on a horse winning the race, or you can bet what they call an each-way bet, which is that the horse will get you the first, second, or third. Now, you get a much smaller amount of money if you bet an each-way bet, but you have 3 times more chance of getting that money than you have of getting the winning money.
Yeah.
Do you know what I'm saying to you?
Yeah.
So I'm happy enough to be, as if you like, an each-way investor rather than looking for the killing. I just don't feel living in an island on the western edge of Europe, thousands of miles away from America and Australia and Japan, that I have a knowledge, that's going to outsmart everybody else in the market.
Yeah. And how frequent is it that companies pay dividends? Does every company pay dividends?
Well, it's interesting now. In Europe, on the continent of Europe, like Germany, France, and places like that, most companies only pay a dividend once a year. So they might pay 100, say, euros once a year. In the UK and in Ireland, historically we were attached to the UK, we pay dividends twice a year. So the 100 euros that you would get in Europe, you'd get 50. You might get say 30 by way of what they call an interim dividend, and you might get 70 by means of a final dividend. So you'd get the same 100 from both companies, but in one case you'd get it paid out in multiples, portions each, twice in the year. In the other case, you get it out once a year. And then in the United States and Canada and places like that, I think they pay the dividend every 3 months, quarterly. So it's the tradition in whatever market you buy the shares as to whether you get a quarter of a dividend 4 times a year, half a dividend twice a year, or the full dividend once a year.
Does every company pay a dividend? So does Google pay dividends? Does AstraZeneca pay dividends? Does Bank of Ireland pay dividends?
Well, the answer to that, Adam, is that not every company pays dividends. The balance that the board of directors of a company have to make is how much money do they pay out to the shareholders, and how much money do they reinvest in the business. So if you have a car and you buy a car for, we'll say, 3,000, and you sell it then a few days later for 5,000, how much has your bank account increased by?
2,000?
2,000.
5,000? Yeah, 2,000.
No, well, you gave out 3, you got back 5. Yeah. So it's increased by a net 2,000. Isn't that right?
Yeah.
So the question is this, right? If you make a profit, the profit increases your bank balances, okay? Correct?
Yep.
Now, the company now has a decision to make. Does it pay that out by way of a dividend, a portion of that out by way of a dividend, or does it reinvest it in the business? So let's say that you're in the business of selling Coca-Cola. You might take some of the profits you've earned this year, and you might use it to help you buy a coffee chain of coffee shops and cafes in the UK. Or you might decide to pay a bigger dividend and not do that. Okay, so those are the decisions that companies have to make. So why did they pay a dividend? They pay a dividend really to make sure that those who are shareholders remain shareholders, so they see some cash coming into their bank each year. So, but they don't want to pay them too much, and neither do they want to pay them too little. So they're looking to see what other companies like them are paying out, and so on. And then they look to see what profit they earn. Generally speaking, I would be very worried about businesses that pay out more than 50% of their profits by way of dividends, because clearly they're starving the company of future finance from the profits. On the other hand, I would have no interest in companies that are only paying out 10% of their profits by way of dividends. So I look and I say, well, if a dividend, if they're paying me out around 5 or 6%, I'm quite happy with that. And then I look and I say, is that under or over 50% of the profits? And if it's over 50% of the profits, I wouldn't invest because I'd be afraid they wouldn't be able to continue doing that. But if it's under 50% of the profits, then I'm happy to continue and I would invest in those companies for the dividends.
So dividends are used as like a form of advertisement, really, to attract new investors and to keep current investors.
Yeah, I mean, for example, I bought Volkswagen shares there recently. I was attracted by them. And by the way, since I bought them, they've come down about 10 or 15%. But I bought them because they'd already come down by 20 or 25% before I bought them. But they're now down very much down. And they're down so much, and they haven't dropped the dividend, right? In other words, they're still paying the same dividends. Okay? Do you know what if you were to buy a Volkswagen share today, do you know what the yield on it would be? It's not 5%. It's not 6%. It's not 7%. It's 7.4%. And now Volkswagen have a problem. If investors are fleeing from the shares and they're paying this high dividend, if they now drop the dividends, that will only encourage more investors to flee from the shares. So they're kind of locked in until the share price stabilizes and starts to grow back up again. They then might decide, well, should we leave the dividend the way it is? Or they might decide to increase the dividend, or they might decide to reduce the dividend. But at the moment, they're kind of locked in. So I believe that Volkswagen was a good buy for me, even though I'm down 10 or 15% in the share. I think that will come back. I mean, do you know when Volkswagen, the business of Volkswagen, was founded? Who was the guy who blessed the first Volkswagen Beetle coming off the factory floor? Do you know who that was?
Mr. Volkswagen?
No.
I haven't a clue.
Mr. Adolf Hitler.
Oh my, really?
1937 wow. Or 1938. So you can see that fits into my logic. It's been around a long time. It has very good sales in Europe. It has very good sales in the UK and in Ireland. And if you take the Audi arm, it has Audi as well as Volkswagen. The Audi arm is a very good car, attractively priced car in the US. So I'm saying to myself, what makes me think that Volkswagen are going to go through the wall and kill me off? I don't think they will. Yeah. I think they'll survive whatever they have to do to get the electric vehicles the way they want them and to get the automated driving or whatever you call that, driverless cars or so on. I have confidence in that company being around for so long with strong management that they will deliver me good dividends and probably some capital gain as well.
So what was the reason for them dipping in their share price?
I don't know, because I can tell you it's trading at a very small, what they call multiple of profit. In other words, go back again to your housing analogy where one guy's getting rent of 1,000, the other is getting rent of 2,000, right? The 2,000 rental property is selling for the same price as the 1,000 rental property, if you know what I mean. In other words, it should be at a higher price given the profits it's earning. So somebody must be thinking that somewhere in 2025 or 6 or 27, it's going to go off the rails. But I don't happen to believe that. I don't see why it should.
Okay. Seems like it would be a risky one, Grandad, because Volkswagen
you won't make money without taking
risk. Yeah.
And
well, that's true.
all your bets won't work. What you're hoping is that for every 4 bets, 3 of them will work and one won't,
Yeah.
or the one that won't work won't sink the other 3. You're hoping that net you'll be ahead. And I was looking at my shares over a 20-year period, and I'm getting about 2.5% a year net on capital gains. And, whereas if I went into Microsoft, I might have made 200%. I'm happy with 2% per year. Okay. And I don't want to take big risks. If I'm getting my 5% dividend and a 2% cap, that's 7 or 8% a year I'm getting, right? What's wrong with that? I can't be taking too much risk if I'm getting a nice steady income, which allows me to spend the money the way I want to spend it in my old age.
Yeah. And it's realistic as well for people at home.
Yeah.
So why don't companies like Google pay dividends? Because they don't need to?
Well, the argument that Google would put to you is that they're in a very fast-moving technology world where they want to get into the cloud and get into artificial intelligence and all these things. And these things are going to cost billions. Now they have hundreds of billions of cash, but they reckon they could need that. So they're saying it's better for us to reinvest the money we have in the business rather than to pay it out to the shareholders. And the shareholders don't mind because the price of the share is going up so fast that, you probably could sell 1% of your holding and you'd probably have enough for 3 years dividends. And in many cases, in many countries, the tax you pay on the gain you make on selling shares is much lower than the tax you pay on dividends, which is an income tax.
Yeah. That could work with you or against you as an investor, though, couldn't it? Yeah.
Yes, it could. The thing is, you speculate to accumulate. You take a risk. You have to take a risk, but you have to be sensible about it and keep the money small, and and be careful what you do, and hope that your more of your decisions gain you money than lose you money. You won't escape. All your decisions won't all be right unless you're God.